I can select suitable financing sources and explain the characteristics of the different types of funding. Evaluate the main sources of finance available to organizations. Organizations can finance projects and operations using a range of internal and external funding sources. Internal sources include retained earnings and operational cash flows, which are generally less costly because they avoid interest payments and ownership dilution. External financing may involve equity financing, debt instruments, bank loans, bonds, or leasing arrangements. Management accountants must evaluate these alternatives based on the organization's financial position, investment requirements, and strategic objectives. In management case study scenarios, candidates should demonstrate the ability to identify appropriate financing sources and explain how each option supports the implementation of strategic initiatives while maintaining financial stability. Explain the characteristics of equity financing. Equity financing involves raising capital by issuing shares to investors. Shareholders provide funds in exchange for ownership rights and potential returns through dividends and capital gains. Unlike debt financing, equity does not require fixed repayments, which can reduce financial pressure during periods of uncertainty. However, issuing new shares dilutes existing ownership and may influence control of the organization. Equity investors typically expect higher returns due to the greater risk they bear. In management case study contexts, candidates should explain how equity financing may be suitable for high-growth investments, large strategic projects, or situations where organizations want to reduce financial leverage. Explain the characteristics and implications of debt financing. Debt financing involves borrowing funds that must be repaid over time with interest. Common forms include bank loans, corporate bonds, and other credit arrangements. Debt financing allows organizations to retain ownership control while benefiting from the tax deductibility of interest payments, which can reduce the effective cost of borrowing. However, debt also introduces financial risk because repayments must be made regardless of business performance. Excessive borrowing may increase financial leverage and raise the organization's risk profile. In management case study responses, candidates should evaluate the advantages and disadvantages of debt financing and consider its impact on liquidity, risk, and capital structure. Select an appropriate financing mix based on strategic and financial considerations. Choosing the right financing structure involves balancing cost, risk, flexibility, and strategic objectives. Management accountants analyze factors such as the organization's current capital structure, cost of capital, cash flow stability, and investor expectations when recommending financing options. A balanced mix of equity and debt can help optimize the weighted average cost of capital, WACC, while maintaining financial flexibility. The nature of the investment project also influences financing decisions. For example, long-term infrastructure projects may be funded with long-term debt, while innovative growth initiatives may rely more on equity. In management case study scenarios, candidates should justify financing recommendations by linking them to organizational strategy and financial sustainability.